Okay class, this video was originally created as a final exam review, and it was through a Zoom session with some online students. So I've edited it to emphasize the items you need to study for the Proctored exam. There will be a couple of multiple choice questions asking if you understand how cash basis and accrual basis are similar or different. So cash basis records revenue and expenses only when cash is exchanged, and it would calculate net income based on just the cash in and out. But accrual basis records revenues and expenses when they happen. They need to be paired up in the right accounting period, the related revenues and expenses that follows the matching principle. So here's an example of a question. You might want to pause it and read these options. We would record expenses when they are used. So when the volleyball camp happens. So when it was hosted is when it would be recorded. So knowing that the revenue and expense accounts go on the income statement, and that creates what we call our net income or our net loss. Then you have that statement of stockholders' equity, which at the end of this PowerPoint, we're going to create all three of these financial statements. You would have just your two main equity accounts, common stock and retained earnings. And something I didn't list on the slide here is that dividends also shows up on that statement, and if you issued any additional common stock. And then the balance sheet is the last one. It should balance all of your remaining accounts that are assets, liabilities, and then the ending totals. Remember, all three of these statements are connected. So that's a quick rundown of the three financial statements that you need to know. The next slide says cash, and I would like you to tell me either on the chat if you think it is temporary or permanent, or with your sign. Checking every answers. Good. I see Matthews. Excellent. The correct answer is permanent. Ready for the next one? Remember, cash, you don't, temporary and permanent accounts, they're saying, do you close them out, right? Only temporary accounts get closed out. We don't close out cash at the end of the month, quarter, or year. Ready for the next one? Unearned revenue. Let me minimize that a little bit. Unearned revenue. What do you think? I got a couple answers on our chat here. Unearned revenue. Also known as deferred revenue. This is a tricky one. I see several of you giving me the wrong answer. So we're going to talk about it. It is actually a liability. Does that help you? Liabilities are permanent, remember? They say, here's what you owe. So unearned revenue, again, it's also known as deferred revenue. It says somebody gave me money and I didn't do the work yet. So I cannot call that a temporary account. I cannot close that out at the end of the month, quarter, or year, because it represents that I either need to give the customer or the client service, a product, or their money back, right? So it is definitely a permanent account. And this is on the, I know this is a test question on the final. Anybody want to tell me what financial statement this shows up on, this account, also known as deferred revenue?
The balance sheet.
Good, excellent, the balance sheet. It's a liability account. Yes, perfect, good job. It's a liability, so it does show up on the balance sheet. Excellent. Next account, common stock, temporary or permanent? Your thoughts? Good job, Matthew. That is correct. It is permanent. We don't close it out. It's something, it's part of your equity. Excellent. Michael got it right too. Retained earnings is another account that I can't remember if it's on here or not. It might be, so I may have just told you the answer. That's another major equity account that does not get closed out, so it is permanent. All of your balance sheet accounts are permanent. Next question. Rent expense, temporary or permanent? Good. 3 accounts. Good job, Matthew. The expense, remember the word I used, anybody, to help you decide which accounts are temporary? It's a color. Does that help?
No, it doesn't help.
Is it red?
Yes. Oh, good job, Michael. Excellent. The red accounts, your revenues, except for that tricky deferred revenue. So Michael is right. Revenue is a temporary, expenses are temporaries, and the D stands for dividends. Okay. Next question. How about accounts payable? What do we think? Good. Good. Excellent. Moving on from that one because several of you got it. That is a permanent account. Good job. It's a liability. It shows up on the balance sheet. It says here's what we owe. Next, dividends. Temporary or permanent? Good. Good answers. Love it. That is a temporary account. Good job. I believe the next, we're going to move on to debits and credits, but I'm not sure. Nope, one more. Retained earnings. What do you think about that one? I already kind of mentioned it. Oh, you gave me your, I clicked it before you gave me your answer. Let's go back. Yes. Most of you are saying retained earnings is permanent. That is correct. Good job. Retained earnings and common stock are both permanent. They're the two main equity accounts. And then I think this is the last one of these. Accounts payable or accounts receivable, sorry. Permanent or temporary? Good. Accounts receivable. What kind of account is it? Let's answer that too.
An asset.
Yes.
Good.
Asset.
I heard asset from two of you, and then Calvin also typed asset. That is correct. It is a permanent account. I believe on the final, you will have to know the definition of several accounts. The definition of accounts receivable is money owed to you from your customers or your clients. So I would either have the definitions handy to most of the accounts, or I would go ahead and write them out like before the test, the study. Min, did you have a question?
Yes. Is the note receivable is the asset?
Good. Notes receivable, yes, is an asset. It's just a long-term amount owed to you. Instead of it being owed over like 30 or 60 days, it is something that a client or a customer or somebody you have loaned out money to is paying you back over maybe multiple years, maybe 5 to 10 years. So the notes receivable is also an asset. It's just a long-term. This accounts receivable is a short-term asset.
I got it. Thank you.
Uh-huh. Good question. Okay, the next one, we're going to say, does cash increase or decrease with a debit or a credit? So if you have a separate piece of paper where you want to show, or type it in the chat. So cash increases with a I think most of you chose this. It looks like on the chat. Good. I got a debit answer too. Good. Remember that I'll say it later. I'll give you a chance to answer a few more of these. But cash is an asset, increases with a debit. On the final, it's going to have two columns, and it's going to say debit and credit. And so in the debit column for cash, you would put increase. You would put increase in the debit column, and in the credit column, you put decrease. Next question. Retained earnings. Does it increase with a debit or with a credit? Does it increase with a debit or a credit? This as your answer for most of you. Credit came up on the slide there. Ready for the next one? Liabilities. Do they increase with debits or credits? Good. I'm seeing most of you saying this one, credit is the correct answer. Remember, assets on the left, if I had my whiteboard, well, I'll use it later. On the left, increase with debits, but liabilities on the right increase with credits. Next question, dividends. Let's see about this one. It might be tricky for some of you. Oh, this one did stump some of you. It actually increases with a debit. Remember that word? That's what I was going to say earlier, but I didn't want to give away all the answers. There's another word that I tried to use or memorize for some of you, that certain accounts, even though they're on the other side of the equation, are said to increase with a debit. And the word was dead. Remember that? Did anybody? I think somebody typed that on the chat. Yes, good job. So dividends increase with a debit. On the dead list, it really says debit expenses, assets, and dividends to increase them. But what is the funky thing? Why is this still follow our equation? All the assets increase with debits and they're on the left. And even though dividends and expenses are on the right, why is it okay for us to say that they increase with a debit? Do you know?
Is it because they decrease common or retained earnings?
That is correct. Gracie said, I don't know if you heard her, but it's because they decrease. We want to show things that decrease equity with a debit. And since they have actually a negative identity, expenses and dividends, when I say I'm increasing them, I'm doing two things. I'm increasing the expense and dividend account, but I'm decreasing equity. So you got to remember that on the test, that expenses and dividends always decrease equity. They are said to increase with a debit, but they are decreasing equity. Okay, a couple more. Oh, we just did this one. So I know you guys will hopefully, most of you get this one right. So expenses, do they increase with debit or credit? Good, good, good. They do. They increase with debits, that dead list, and it's because they also have a negative identity. Expenses increase with a debit. I think we have one more here. Let me see. Yeah, common stock increases with a debit or credit. Good. Good. Your chat and your signs look good. Increases with a credit. Oh, I lied. Maybe this is the final one. How about revenue? Increases with debits and credits. Good. A lot of you said that revenue increases with a credit. That is right. I'm going to go over that dead list again. I typed it on the chart, on the chat, but the dead list says that you will debit expenses, assets, and dividends to increase them. If an account is not on that dead list, such as revenue, there's no R in the word dead, they will increase with credits. So if it's on that list, it's said to have increased with the debit, but if it's not on the dead list, such as liabilities, common stock, retained earnings, revenue, those things increase with credits. Good job. Okay, last one. I keep on lying. This is the last one though, I promise. Assets increase with a good. I saw your signs. Excellent. Isn't it just like being in the classroom that I made you write these things? The correct answer here is debit. Good job. All right. Adjusting entries. There are 5 adjusting entries you have to do. So the next, this slide and the next one will include all the adjusting entries you have to do. I did not put the amounts on here. I just put the accounts that you will have to record. And again, these are also drop downs. So if you're unfamiliar with how to calculate the amounts, you need to go back to chapter 3 and work on how I would calculate the supplies adjustment amount. So when I use up supplies, what do I debit? Any guesses?
Supplies expense.
Good, excellent. Supplies expense. A lot of your adjusting entries, and that's why I put these first three on this same slide together. A lot of your adjusting entries are going to debit an expense account. So when I use the supplies, I will debit supplies expense to show the used amount, but I have to take away from the actual asset, so I'm crediting supplies. The next journal entry, when I use up prepaid insurance, looks very, very, very similar. I'm going to move this out of the way here a little bit. Yeah. I will debit the insurance expense and I would credit prepaid insurance, but that will have to be for the amount that you actually used. Don't record that as the amount you initially purchased. That has to be for the part that got used up. So if I bought a whole year's worth of insurance, let's say on November 1st, I would only record 2 months on the adjustment as being used. And then the last adjusting entry on this slide is the calculation of interest on a loan that you have taken out. It will, again, another adjusting entry that debits an expense account. It would debit interest expense and credit interest payable. And I don't have it on the slide, but you will have to know how to calculate that. Remember, it was the loan value principal times the interest rate, and then prorated for the number of months that have actually passed. So divide by 12 and multiply by the number of months that have passed. Questions on any of those adjusting entries? Okay, so the other adjusting entries are these first two, the utilities accrued. Let's take a random guess. What kind of account do we want to debit? Any guess what you want to debit here?
Utilities expense.
Good job. Excellent. Utilities expense. So utilities expense reflects the amount that you've used, and the accrued part just tells you that you haven't paid it yet. So good job. Same, these are gonna look very similar overall. Adjusting entries reflect that time has passed and something has been used up. The depreciation entry is gonna debit an expense account, depreciation expense, and then it's gonna credit accumulated depreciation, which, do you remember what kind of account that is? I'm not sure if it's on the chat or not.
Contra asset.
Good. It's a contra asset. Very good. Excellent. So what's happening here is I'm decreasing equity. All of my expense accounts decrease equity, and the accumulated depreciation is decreasing assets. Good job. And then the last one I put on this slide, because I know it's a multiple choice question, is reflecting what you would record when you provide services on account. It's not an adjusting entry, but it is one you'll need to know for a multiple choice question. So you would debit the accounts receivable. Remember, the word providing services tells me I need to record service revenue. I did work, and then the accounts receivable says I haven't been paid yet. Okay, two major accounting principles that we've discussed and will be on the final as multiple choice questions are the revenue recognition principle. It says you record revenue when it's earned. So only when we do work do we record the revenue, right, on the revenue recognition. The matching principle says that expenses and revenues have a relationship. Remember, I would do this sometimes. And they need to be recorded in the same time frame. So if I had, here's a good example, insurance, and I remember we said on the adjusting entries, if I paid for a whole year, I would only record the amount that I've used in the current year to generate revenue. Or supplies, I would only record the used amount of supplies that I had to use up to generate that revenue. So these are easy, I think, multiple choice questions if you will make sure you're familiar with the definition of those principles. Any questions on those two? Okay. Then closing entries, this is the last slide. You will have to do these as drop downs. Remember, I highlighted these in red because these are the 3 types of accounts that you close. You close revenues, expenses, and dividends. And you do the opposite of their normal. So just how we went through that list earlier, and we said the dead list, that tells me that I'm going to debit expenses, assets, and dividends to increase. That's also telling me they're normal. So dividends normally have a debit balance, but when I close them, I will credit them. And then the expenses normally have debit balances. So when I close them, I will credit them and debit into retained earnings. And revenue normally has a credit balance. So to close it, I would debit it and credit retained earnings. Questions on those?
I have a question that on the revenue, how about the sale discount? Do we need to debit it or credit it?
If you were closing, if there were a problem, I know on the final, when I make you do the closing entries, you don't have sales discount, sales return, or sales allowances, but those normally have debit balances. So I would credit those accounts to close them. They are like expenses, okay? They offset the revenue, they decrease the total revenue, but on the closing question for the exam, it won't have those as part of the problem.
Okay.
Any other questions on the closing entries? Nope. Okay, last thing then for this review is going to be for us to create